Hello guys, I go by the name of Ammarullah. It's been a long time since the last time I was online. Man has been going through some things, some personal stuff. So in this video, I'm going to reveal some things very important to you guys. So make sure you watch this video from the beginning to the end because it is very important. I'll show you how all these things were being drawn or make the analysis from top down to where it is right now, to where you are seeing it at as, and to even the way you are going to take a trade like this, something like this. So make sure you like this video and subscribe to the channel for more content like this. So we are going to start with top down analysis, right? We are going to start with top down analysis. What is a top down analysis? I'm going to explain a top down analysis to you guys so that maybe there may be somebody that is just hearing the name for the first time, right? So a top down analysis is simply analyzing the financial market from a bigger time frame, right? From a higher time frame to the lower time frame to spot the levels, some levels and trends, and to know where to enter the market from, where to enter a trade from, to find your entries and the direction. You find the direction from the bigger time frame, from the higher time frame, then you look for your confirmation or the trend of the market. From the mid time frame, that's the medium time frame, which are the 4 hours and 1 hours and stuff. It all depends on where is your higher time frame. Then you drop down to the lower time frames to look for your entries and execute the market. It's as simple as that. That's the top down analysis, right? So let me delete everything that is here on this chart to show you what a top down analysis is, right? So as this chart is empty now, the top down analysis, some people normally start their top down analysis with monthly or something. Even everybody can do it. It's just to know the overall direction of the market, right? So this is the monthly time frame. We see the market from here. It was from 2022, if you can see down here, till date. It's rallying up, right, on monthly time frame. Weekly too is showing us a strong upward movement, right? The price is going upward non-stoply. So that's the only thing we want to see on this time frame now. Where is the trend of the market going, right? From this high, low, high, right? The market is strongly in uptrend until now. That the thing is ranging. The market condition is ranging currently, but the overall is high, uptrend, right? Then we come down to daily time frame to confirm what is daily speaking to us too. So daily time frame too, from this low now to where the market is at right now, is continuing to the direction of monthly and weekly, right, which is uptrend. Then now it is ranging, if you can see from here. After this high, low, high, lower high, then lower low, then it keeps oranging at where it is now, right? So it's showing us ranging until when are we going to start looking for an entry opportunity outside the ranging? Until when one of these is out, either this low that was being formed after this high or when this high is out. So right now the market is ranging in a particular level, which is here and here. So this is where we are going to be trading inside the range. This is what the market is showing us right now, right? And the market take out this low just to fill this imbalance of price, which is a fair value gap. What is a fair value gap? A fair value gap simply means a level of price where there is an imbalance, where a particular direction offered an imbalance to the market, right? Especially in smart money concept, fair value gap refers to a price level where a particular pair is considered imbalance. What am I even saying? Which kind of explanation are they give like this? If you right, let's continue from where we stopped. A fair value gap is a price imbalance on the financial market chart, right? Where the market moves too quickly, leaving one or two candles without overlap, right? Without being filled, without a gap that is not being filled. Normally, before price leave a particular direction, it normally offers a fair value between the buyers and the sellers. That's as simple as that. But when the price move quickly without being offering a particular direction, either direction of buyers or direction of sellers, so that range, that particular candles that will be left unfilled, those are fair value gaps, just like this candle now that I just marked right now. So this candle, and this candle made a fair value gap, a gap that was not being filled. It only offered buy side, but it didn't offer sell side. So the market came back to it to offer a market fair value, right? To offer a fair value to the marketplace, right? So after that, then the market continues to range in a particular level. So let me delete all this. So after we know we have that in the back of our mind on the daily time frame, then we come down. We are just like this. We are doing the top down analysis. Then we come down to the mid time frames, which are the 4 hours, 1 hour, 2 hours, and all that stuff. So we come down to the mid time frame to look for opportunities and confirmation, right? To look for confirmation of what we are seeing in the higher time frames, what we are seeing on the higher time frames, right? So this is the particular place, this level is when the market offered the fair value, right? When the market returned to that fair value gap and mitigate it and fill it, right? Then after filling it, if you can see, the market made this high, then low, then another spiking up. It rallied. You are not going to just wait for the market and be watching it until when it come down and break this high or something. This is where you look for your entry of opportunity to enter the marketplace. So how do you do it? You are going to use your Fibonacci retracement, which is this tool. After mitigating this particular price level, then it made this high. So where you look for your entry is at the equilibrium of this range. What is the equilibrium? Equilibrium simply means the midpoint of a price level, of a price movement. So you use your Fibonacci retracement tool to measure the equilibrium, the midpoint of a particular price level, right? From this low now to this high, the midpoint of them is this 50%, this particular level. So anything that will be below equilibrium, that will be discount, and anything that will be above the equilibrium, that will be premium. So whenever somebody is looking for an opportunity to buy a specific pair to go long, right, they will always be willing to buy at a discounted level, right? Then you look for your opportunities, entries opportunities below the equilibrium, right? Maybe a fair value gap below the equilibrium, or any other PD array, right? Maybe other block or anything. We'll come to that at the end of the video, inshallah. So the price sold down to the equilibrium, then here is a buy. You click your buy and just hold the trade until take profit. You can see it delivered perfectly well. So after making this high, the price still sold down to this level. Guess what? It's still sell down to the equilibrium. If you can see, if we measure it from here, from this low now to this high, it sell down to the 50%, then continue going up. This is just how the Fibonacci retracement tool will help you to spot some movement. So you look for a particular level that the price will likely sell down to, whether at the discount or at the equilibrium, which is this particular thing, this particular level. Now this is a fair value gap, right, at the 50% level of this range. That's at the midpoint of this range, from this low to this high. So here is the fair value gap we have right there. So one can take their trade right there and target right here, stop below this low, or right here at the other block, which is a good entry, right? So let's continue from where we are. After this, then the market continues to go higher, breaking structures, right? Breaking structures from this to this, then this high, this particular price movement, take out this, and the particular place is left with a level of order block. What is an order block? An order block simply means a particular level or price zone where the institution or the big players, right, the institution or the banks normally buy an asset or sell a particular pair, right? It normally acts as a support or a resistance. Normally, whenever price return back to particular order block, the price normally react to that level, either of buyers or of sellers, right? So this is the particular order block of this price movement from this low now to this high, after mitigating the fair value gap that is down here. This is the particular order block that was been left with. Then the price came back to it and rally up again. That lead to another break of market structure right here. So, but maybe you ask, why is it that when the price came back to this level of order block, it did not respected it? Yeah, because now, as it was being mitigated, the place is turning back to another thing, which is an inducement level. It's an inducement level. It's an inducement level. Inducement level simply means a trap, right? An inducement level is a price area designed to trap the retail traders before the real move happens. right, before real move happens of the big banks, big players like the institutions, right? That's an inducement level. They use the level to trap the retail trader so that they will execute their trades after taking out the liquidities of the retail, right? So this other block that is not be respected, or that was been mitigated once, may serve as an inducement in the future of price movement. So now this has turned to an inducement level. Then the price came down and swept it down to offer more discount to the price level from this place. Just remember, we are starting the analysis, the confirmation from this level, right? And we still have our Fibonacci retracement to offer a discount to the marketplace. Now this is our new high. From this low to this high, this is our new high. So we are going to measure from this low to this high now, and see where is the equilibrium or the discount level, right? So after making this high, the price sell down below this equilibrium, below this inducement level, to offer a discount price range to the marketplace, right? If you can see, this is our 50%, right, which is our equilibrium. So the price sell down to 62% level, which is inside the discounted level, right? Then keeps on ranging. That's what caused the ranging of the market place. So now our next movement after making this is we are going to expect the market to come back to a particular price level and take it out, maybe a high or a low or something. We are always looking for an opportunities to buy the market, because the overall market is uptrend. So we cannot be looking for sales in an uptrend market, right? So after taking out this inducement level, the price, before taking it out, it first made a high, which is right here, right? After making it, then it take out the inducement level and offered a discount price range, which is below the 50% level. Then the market rallied up and take out the high. So there we are going to look for more entry confirmations, which is for more entries, which is marking the midpoint of the price range from this low to this high. The midpoint is this 50%. Then the discount level is below the 50%, right? So below that 50%, after this break of market structure, what do we have? We are going to look for an order block or a fair value gap below the 50%. That's below the equilibrium, which is this, from this low to this high. Now we have this level of fair value gap, right, which the market sell down to and reacted to it, right? And we still have this fair value gap. A fair value, an order block. An order block is a last candle before a. We always see our order block as the last candle, either bearish or bullish, before a strong upward movement or downward, right? So this is our last candle from this week low and to this week high. That is our order block, right? So when the price came down below the equilibrium inside the discount level, it did not reach the order block, the last candle. You understand? This is what we call an incomplete pullback. An incomplete pullback is always an inducement level, right? It always serves as an inducement. It will do as if it wants to come back to the main place we are expecting the market to be. Then it will fail to reach the particular place, either a fair value gap or another block. So the price fell to tap into the other block, so that is an incomplete pullback, and which always serves as a liquidity to the market, which is an inducement, a trap. It's trapping the readers, right? It's trapping the readers to make them think that is where the real move is going to happen. And after all that the price did, when reaching this particular level, it made this high, then sell down to tap into that other block to fill that incomplete pullback, right? Then it swept the liquidity that is at the inducement level, right? It swept the liquidities, the retail traders, orders, and tap the other block, if you can see right here. So that was where I placed that long position trade. But mind you, I did not just place the long position entry tool because I see the market return back to the other block, because it may just decide to go down. You need to wait for an entry confirmation before just taking a trade, right? After tapping to the other block, we know that is where the price is likely going to react to. So what we do, we are going to go down. Normally we will go down to the lower time frame, lower than the 4 hour, which is the lower time frame that I said one is going to use them for entry confirmations, right? So since we use 4 hour, we can go down to either 30 minutes, 15 minutes, or anything. But me, I like to trade 30 minutes or 15 minutes, not lower than that. Sometimes 5 minutes, but just sometimes. So after we have this strong bearish movement that leads to the tap in the other block and sweeping this particular inducement level, so the price rallied up again one more time. It rallied up and made this high, right? It first, before tapping it first made this short time high, which is right here, short time high, then tapped it and take out the high. That is to show you that yes, now we are going higher. We are done with the correction, we are done with the inducement sweeping, and the other block is completely tapped now. It's not an incomplete pullback, it's a complete pullback and a change of character. This we call it change of character, where the movement direction, like the movement of the market is changing from a particular, either from the sells to buys or from this buys to sells, right? So we are always looking for buys. What do you expect? After the market made this high, then it sell down again to a particular level of maybe inefficiency, fair value gap, or another block. As you can see, high, then an incomplete pullback again, which is a trap. As I told you, this is a trap because it is above the equilibrium from this low now to this high. This small reversal now is above the midpoint of this particular price level, right? So we cannot use it to take a trade because it did not offer a fair value or a discount to the market price, yet we cannot buy the market, right? It have to offer a fair value, like an equal value before we buy it, right? Or a discount value before we buy it, right? Since we are looking for buys, so it was an incomplete. So that level 2 will serve as an inducement, right? As an inducement where it will trap the retails or something, right? Then the price came down and sold down into a deep discount, a discount level, which is correlated with a fair value gap. If you can see right here, a fair value gap is down inside the discounted level, right? So that is where we look for our entry, we see our entry confirmations, and as the price came down to it reacted. This reaction now is where we take our trade at. Can place our limit order right here, or wait for the market or to reverse here and take it, or even here. So far it has tapped the level of fair value gap inside a discount level of the Fibonacci retracement. We can take our trade right there. So that was where I placed my entry. Then stop loss will be below this low or below this level. If you are willing to hold it for a long period of time, it should be below this place. So below this low, and the first take profit should be this high right here, right? That's the first TP. The second TP above this high, the third TP above this high, right? Which all of them has played out. If you can see, all of them has played out. Only 3 take profit. If somebody is willing to hold a trade for a long period of time, then he will go back to the bigger picture, the bigger time frame, and drag the take profits, the TP, the targets, to this particular high, and the stop loss should be below this level of order block, right? Which is a 1 to 3 risk to reward. But this particular place from here, for a scalper or day trader, it will be a 1 to 3 2. Then that's for the TP1, for the TP2 1 to 3.7, for the TP3 1 to 5, right? It's a very good trading opportunity. So in this video, that's how the video come to an end, right? So thanks for watching to this level. If you genuinely reach this level with this particular ending of this video, I just wish you learned something new today, right? If you did, please hit the like button of this video and subscribe to the channel for more videos like this to come. Bye.